Hi, everybody. Welcome. Thank you for joining us today. We're going to have a very interesting session today on adaptation at home, on consumption, building codes, and insurance. So thank you very much for joining us today. First up, we want to thank our sponsors for the Climate Adaptation Research Symposium, and also give you a few hints on how to use this interface. First of all, widgets are resizable and movable. You can drag the presenter's video around your screen, so you can go ahead and drop me into the bottom corner. I'm probably the least interesting thing right now. And go ahead, and if you have a question for presenters, you can click the question mark icon to ask them in the Q&A, and then we will turn to the audience's questions at the end of the session. So today we're going to be hearing about a number of interesting different factors around climate change and how they intersect with the personal world, both how things like insurance and public policy and financial factors in turn impact how people's homes are impacted by climate change and how their spending habits are impacted by climate change. And we have three great speakers up for you today. First, we have Yanjun Liao of Resources for the Future and University of Pennsylvania, and then Judson Boomhower of UC San Diego, and wrapping up will be Wangyang Liao of the Shanghai University of Finance and Economics. So first, I'll turn it over to Yanjun to take it away with her talk about what's at stake on understanding the role of home equity in flood insurance demand.
Hi, everyone. Can everyone see me?
I can see you.
Great. All right. Thank you for the introduction, Laura, and thank you very much to all the organizers of this event. I have learned a lot today, and I look forward to our section. Today, I'm going to present a recent working paper on understanding the role of home equity in flood insurance demand. This is joint work with Philip Mulder, who is a graduate student at the Wharton School of Business, and he's also on the job market this fall. He has a fantastic job market paper looking at adaptation choices at the property level, and it's a novel data set that he has put together that no one has seen in this literature. So it's a very exciting paper. I just want to give a shout out to that. So in this current paper, we're going to look at flood risk. Flooding is the most frequent and expensive natural disaster in the US. Here in this map, I'm showing the projected change in flood risk in the next 30 years across US counties. Purple indicates an increase and orange indicates a decrease. And as you can see here, much of the US are projected to see an increase in flood risk in the near term. And so this will have a profound impact on the mortgage market because flooding can increase displacement, mortgage delinquencies, and foreclosures. Last year, the New York Times has done a story on how the rising seas could threaten the American institution of the 30-year mortgage. And this is why flood insurance is so important. We've now seen pretty convincing evidence that having flood insurance largely protects households against these adverse financial outcomes. And so when we talk about building preparedness to flood risk or building resilient communities, flood insurance has always been considered a central part of the policy toolset. And yet, millions of properties at risk of flooding across the US are currently uninsured for their flood damage. And this is known as the flood insurance gap, and it's something that flood risk researchers and policymakers have been grappling with for a long time. Some of the conventional explanations for the flood insurance gap is that maybe households have imperfect information about their flood risk, or that they suffer from some behavioral bias, have difficulties processing information about risk. In this paper, we provide a new explanation that is based on incentive. And our central idea is that if households have a low stake in their property because of a highly leveraged mortgage, then they might not have incentive to fully account for the disaster risk on the property. And that could lead to underinsurance. So specifically, our research question is how and why does home equity affect flood insurance demand? The first thing we do in this paper is we write down a model to explore how home equity factor into the decision about flood insurance. And we find that, in fact, if a homeowner default after having suffered from a flood, um, it sort of provides a high deductible implicit insurance. Now, let's say I'm a homeowner and my house is severely flooded, and I don't have insurance. Then I can do one of two things. I can either pay for this high flood loss out of pocket, or I can choose to walk away from my mortgage, in which case I would lose my home equity, but I'm no longer responsible for the flood damage. Now, this is a kind of implicit insurance. If I have low enough home equity, then I might rely on the implicit insurance instead of formal insurance to get through the scenario when heavy flood loss occurs. Whereas if for a homeowner with high levels of home equity, defaulting becomes very costly, and the homeowner would be better off buying formal flood insurance. And so through this mechanism, we find that higher home equity would drive a greater demand for flood insurance. We then take the prediction of this model to data and see whether it checks out there. The empirical analysis comes in two parts. In the first part of the analysis, we establish a positive causal relationship between home equity and flood insurance demand. And this relationship is identified using sudden variations in housing prices coming from the housing booms and bust in the 2000s. In the second part of the empirical analysis, we try to disentangle two mechanisms that can drive this relationship. And I apologize for a very chatty cat in the background. So in this mechanism test, we find that besides the default incentive mechanism, which is our focus in this paper, there is another mechanism that can drive a positive relationship between home equity and flood insurance demand. And that is by relaxing the household's liquidity constraints, because they can now borrow against their home equity more easily if they have higher home equity. We test several predictions from both of these mechanisms, and in general, we find support for the role of default incentive, but not liquidity constraint. In terms of research design, we're going to look at flood insurance demand in the National Flood Insurance Program, the NFIP. This is a public program run by FEMA, and it provides about 95% of all the flood insurance in the US. We aggregate policy level data to the MSA level, and we construct the quarterly panel of 271 MSAs going from 2001 to 2017. The key challenge in trying to understand how home equity affects flood insurance demand is, of course, that home equity can be correlated with other factors in flood insurance demand, such as income, education, the replacement value of the building, and the expected flood loss, etc. Our solution here is to use sudden price variation in the housing booms of early 2000s as instruments. So around this time, there are speculative activities driving up housing prices in many housing markets. And these variation has been shown to be uncorrelated with underlying economic fundamentals and demographics. But they drive rapid land value appreciation, which then lead to an increase in home equity. So this is a variation in home equity that is not correlated with these other factors in flood insurance demand. And so we can make use of this variation in our causal identification. In terms of econometric technique, we are going to embed a difference in differences into an instrumental variable framework, and more on that later. So, what is the housing booms? Here I'm showing you the housing price index, the time series of housing price index in 4 housing markets. You can see that on the left in Athens and Galveston, the housing price index goes up smoothly between 2001 to 2006 without any kind of sudden change. Whereas in Tucson and Naples, we see that there is a clear break in trend happening around 2004 quarter two. And after this break, there is a sudden acceleration in the growth of housing prices. The housing literature has studied this phenomenon extensively, and they found that the housing booms around early 2000s is actually a series of booms with different sizes in different housing markets. And they did develop a method to identify the size of this trend break as the size of the boom in each of the markets. And they occur in slightly different timing and with different sizes. And so that will be the variation we're going to look at. Now, if we put together the housing boom size and the change in flood insurance take up between 2002 to 2007, then we see that there is a clear positive relationship. So each of these circles is an MSA. And the larger the housing boom, the faster the increase in take up between 2000 in take up of flood insurance between 2002 to 2007. And so this is a relationship that we're going to apply formal statistical analysis to quantify. Specifically, we run the following specification, which we consider as a continuous treatment event study. So we regress the outcome of interest. It could be the housing price index. It could be the log of policy count. We regress this on a set of event time indicators. So these are indicators for each quarter relative to the beginning of the boom, interacted with the structural break instrument. So how large is the boom? And then we control for a set of covariates that we worry can also change because of the housing booms. For example, income, home sales volume, population growth, employment rate. We control for the dynamic effect of risk by interacting the baseline risk level with a set of year indicators. We control for recent flood claims because flood history can affect flood insurance demand. And then the MSA fixed effect and year fixed effect. Our coefficients of interest are these alpha taus, and they're going to flexibly capture the trajectory of the outcome relative to the boom size and the start time in each MSA. So essentially the identification is we compare the outcome in a high boom market versus a low boom market and see how that changes. So if we run this regression on the housing price index, here's what we're going to find. We find that there is a pretty flat pre-trend, and then there is a sudden increase start at the beginning of the boom. And then there is a boom bust kind of trajectory, first going up and then peaking at the end of the third year and then going back down again. And this is because the housing boom and housing bust are kind of, two sides of the same housing bubble. And so those areas that experience a larger boom also experience a larger bust. And so this is to check that in the first stage, when we look at whether the housing boom drive the housing prices, we find very significant and economically important effect. One standard deviation increase in the boom size is associated with a 15% higher home prices at the peak. We then move on to estimate how the housing booms are going to drive take up in flood insurance. So here, the outcome is the log of total NFIP policy count. And we see that again, there is a pretty flat pre-trend suggesting that, the high boom markets and the low boom markets prior to the boom do not see differential take up in flood insurance. But after the boom started, we then see the same kind of going up and then down pattern. And the peak is also around the end of the third year. So it lines up really well with the housing price reactions to the boom. In terms of the scale, one standard deviation increase in the boom size is associated with 5% higher take up at the peak. We also test other things, and I don't, since for the sake of time, I'm just going to summarize it here for you. We find that the effect is not driven by the insurance purchase mandate in the special flood hazard areas, or otherwise known as the 100-year floodplains. Inside these 100-year floodplains, homeowners with a mortgage that's federally backed are required to buy flood insurance. But we find that this effect, in fact, is stronger outside of those 100-year floodplains. So it reflects a kind of voluntary decision making by homeowners who are not subject to any kind of mandate. We also find that the effect is not driven by new construction because the effect exists at a similar degree within those properties built before the boom starts. We also find that the effect is not driven because households renovate their buildings due to the housing booms. And so this is not because the buildings become more expensive to cover. And then in terms of other insurance choices, for example, how much deductible they want or whether they would cover the contents inside the home, we find that these choice margins remain quite stable across this period, suggesting that risk preferences as well as perceptions remain quite stable across the boom bust cycle. And because of all these auxiliary findings, it reassures us that the housing booms affect flood insurance take-up primarily through housing prices, but not these other channels. We then move on to estimate the scale of this housing price effect using a two-stage least square estimation. So if we look at all of the policies, then we find that the estimate is about 0.3, which means that a 1% increase in housing price is associated with a 0.3% increase in flood insurance take-up. And if we compare this to other primary factors in flood insurance demand, for example, we find that the effect of home prices going up by 1% is equivalent to the effect of the premium going down by 2%. And then the effect from a hurricane hit in the nearby area, which typically drives up flood insurance demand for a few years, that effect is equivalent to home prices going up by 4.8%. So in general, in terms of the magnitude, this is a pretty substantial magnitude. We also separately estimate the elasticity for those properties inside the floodplains versus the properties outside of the 100-year floodplains but are still at risk. And we find that, again, this estimate is much larger for the non-SFHA policies who are not mandated to buy flood insurance. When we separate out the effect during the boom and the effect during the bust, we see that when during the boom, we estimate an effect that is very similar to the aggregate effect we just seen. And when we go to the boom, we see that the bust, the bust, there is a much larger effect during the bust, especially this is the estimate on those properties that are built between 2003 to 2005. And so you can imagine that these properties are built while it's booming, and then they're sold near the peak of the boom. So then when the bust starts, what happens is that their home equity goes to a very, very low level, it could possibly go to a negative. They could have negative equity, and we find a particularly large effect among the set of policies, strongly suggesting that this has something to do with the home equity going very low, and it's consistent with the implicit insurance mechanism. Um, so then we go on to test for the mechanism underlying this causal effect. So in our insurance model, we find that there are two potential economic mechanisms. The first potential mechanism is the default incentive mechanism, whereby lower implicit insurance value, higher home equity lowers implicit insurance value from defaulting. And we test two predictions here. The first prediction is that we should see a larger effect in MSAs with lower transaction costs of default. So here by transaction, I mean things like how soon would the homeowners be evicted from their house, whether they would be charged random fees by their mortgage lenders, and things like that. And we use a variation in state law, foreclosure law. So in some states, um, there are judicial review laws where all the foreclosures have to go to court. And this has been shown to protect the borrower's interests and make the foreclosure less costly for them. And so in those places, we are supposed to see a much stronger mechanism, and that's what we're going to test for. In the second prediction, we're going to see a larger effect in those MSAs with greater non-SFHA tail risk exposure, because it's the tail risk, like severe damages, that is relevant to this mechanism that would cause people to default. And then in terms of the liquidity mechanism, we're going to look at 1-year renewal rate, because insurance non-renewal is often associated with liquidity conditions. And so if the liquidity condition is improving and is driving up the insurance take-up, then we should see an increase in 1-year renewal rate at the beginning of the boom. So what do we see? Here we see that in terms of the housing price index, on the left, both MSAs with the judicial review law and without have similar responses. But if we look at flood insurance take-up, the blue line, which represents those MSAs with judicial review and lower transaction costs, has a much stronger effect. And so this is consistent with the implicit insurance mechanism. And because of time constraint, I'm just going to show you the two-stage least square result. So in the first column, we see that the differential effect for those with judicial review laws are almost twice as large as the baseline effect. And for those with high tail risk, we see the similar, much larger effect. And then if we look at renewal rate, we do not see the increase in renewal rate, suggesting that this is not likely to be driven by liquidity conditions. All right, so let me just conclude. We have identified a new incentive-based explanation of the flood insurance gap, where the homeowners rely on mortgage default as an implicit insurance. The magnitude of this effect is quite substantial. And there are a few implications for disaster risk management in terms of, how the risk is distributed, that part of the risk gets transferred to the mortgage lenders, and ultimately it could get transferred to the taxpayers, as a lot of these mortgages are securitized by the Fannie Mae and Freddie Mac. There could be moral hazard issues where homeowners do not fully internalize their risk. And so we also suggest that some of the potential solutions should focus on reflecting the risk in the mortgage system, particularly for those homes outside of the 100-year floodplains. Thank you. Is there any should I answer some questions or something?
To hear me now?
Hi. Yes.
Hi, sorry about that. Took me a second to get off mute. Um, so let's take a look. So we have just a few minutes for questions. So actually, I have a question to start us off, Yanjun. So my understanding from your talk is that, well, that people have sort of traditionally thought that the reason people are underinsured for flood is because they don't really understand the true risk. They have some kind of lack of information, that they're not behaving the way they really should if they were acting in their own self-interest. And
Yes.
you're presenting this alternative hypothesis, which is that people actually are acting in their own self-interest, given that they often have very little equity at stake if they do lose their home in a flood. So first of all, that's really interesting because it kind of switches the traditional thinking on its head. And then you're saying that this creates all kinds of problems because it means that taxpayers end up on the hook for when homes are lost rather than insurers. So is there a solution? Is the solution in changing the incentives for people to get insurance? Do policymakers need to step in with mandates? What do you see as the way to solve this problem?
Yeah, that's a really good question. And I think any solution is quite complicated. Obviously, there are a lot of other considerations going into it, rather, instead of just focusing on reflecting the risk. But in general, I think that going in the direction of having the risk reflected is the right direction. It could mean things like maybe lenders need to start paying attention to the risks on these properties, that maybe they need to think about requiring flood insurance even outside of what is mandated. It could also mean that potentially expanding the mandate to 500-year floodplains, not just 100-year floodplains, because some of the recent findings show that a lot of the houses outside of the 100-year floodplains could also be very much at risk, and even at comparable levels of risk. It could also mean that maybe the government sponsor enterprises such as Fannie Mae and Freddie Mac should consider, you know, charging a higher fee for securitizing some of these mortgages, or at least have an understanding of what is this risk and what can be done about it.
Thanks very much for that answer. It obviously is an extremely challenging situation. So thank you so much for that. I
Yeah,
think
thank you.
we are going to turn it over to Judson now. Thank you, Yanjun.
Thank you.
Let's see. I'm hoping that folks can hear me.
I can hear you fine.
Great. And it looks like we need to catch up on the slide.
Yeah, I think that Yanjun had an amazing amount of information that she wasn't able to get to for people who want to go read the paper. So here we are. So here is Judson Boomhower, assistant professor at UC San Diego, and he's going to be talking to us today about building codes and community resilience to natural disasters. Welcome, Judson.
Awesome. Thank you, Laura. Yeah, thanks everyone for being here, and thanks for inviting me. I'm really happy to be back at this conference. This is such a great conference, second year in a row, and I'm really learning a lot and enjoying it. So thanks everyone for being here, and I sympathize with the constraints on time that our previous presenter faced. This is also normally a full academic research talk that goes for 90 minutes. So I'm gonna go quickly through parts of this. But if I skip over details that people want to talk about in the Q&A, please just bring them up in the Q&A. Okay. So let's see. There we go. Yeah, so the first thing I should say very importantly is that this is joint work with my co-author Patrick Bayless at the University of British Columbia. So we're thinking about building codes and disaster resilience in this paper. And I think at a higher level, we're thinking about this important distinction between a world where we mandate adaptive investments versus a world where we rely on people to mitigate the risk of structure damage during natural disasters. But we also know that take-up of those investments is complicated due to a bunch of factors that I'll talk more about in a minute. And so against those, what you might think of as frictions for adaptation, we have, oh, looks like I was frozen, but I'm hoping that I'm back now. Great, okay. So I was just telling you some things that you already know, which is that disasters are getting worse and that there are things that we can do to mitigate the property damage when disasters happen, but that take-up of those things is sometimes complicated. And so we have this growing number of government initiatives to require or subsidize take-up of adaptation and mitigation investments in high hazard areas. It turns out that we don't have that much evidence about okay, my camera's off. I'm relying on feedback in the chat to tell me if I'm back. Okay. I guess the UC San Diego Wi-Fi is not doing so well today. So I told you that we're going to think about how the world looks when we mandate adaptation versus when we rely on voluntary adoption. And we're going to think about that difference in the setting of wildfire building codes in California. So this, of course, is a very important risk. We've had about $40 billion of property damage in the US in the past 5 years, much of that in California. This number, after the past few weeks, is going to go up even more. So this aerial image here is of the Tubbs Fire footprint in Santa Rosa in 2017. Okay, so let me tell you what we're going to do in this paper. What we're going to do is we're going to evaluate the effect of California's wildland-urban interface, or WUI, building codes on the likelihood of survival of my own structure when it's exposed to a wildfire, and the likelihood of survival of neighboring structures when we're faced with a damaging wildfire. So to do that, we assemble parcel-level damage data representing almost all United States homes destroyed by wildfire since about 2003. We merge that comprehensive list of destroyed homes to the universe of real estate assessor data for all of the destroyed and surviving homes inside of these wildfire perimeters. So that means we can see not only the homes that are destroyed by the fire, but also homes that are exposed to the fire and survive. We're going to take advantage of differences across jurisdictions and over time in building code requirements to measure the effects of building codes on structure survival. And then the last thing we're going to do is we're going to measure the spillover benefits of mitigation for neighboring properties due to reduced structure-to-structure spread during WUI fires. And this is a slide that I'm going to skip for time. And I want to take a couple minutes and just talk about a few reasons why you might expect different outcomes in a world where you have a statewide mandate for wildfire mitigation and construction relative to a world where you rely on homeowners to make those investments themselves. Or another way of asking that is, if these technologies are so effective at protecting homes, why do we need government intervention and why don't homeowners just recognize that this is something that they should be doing? And so let me just put out a few sort of reasons that you might think the world would look different under a regime of statewide building codes. The first is that we have really good evidence from a lot of previous studies that homeowners often underestimate wildfire risk. So they may not perceive the benefits of investing in mitigation. The second is that an economist would say this is a setting with really important spatial externalities. And that's just a fancy way of saying that my risk mitigation choices on my house don't just affect me, they affect the homes located near me, right? So if my home catches fire, it's more likely to spread to neighboring homes and destroy those homes as well. This screen capture from the LA Times, I think, makes that point really nicely. And in this world of spatial externalities, if we think that homeowners are primarily thinking about their own benefits, then they're going to face insufficient incentive to make these adaptive investments. And then lastly, I'll just say quickly, in the paper, we talk about some interesting incentive issues that may come up when we think about local governments and local government decisions about whether to require wildfire mitigation. These rules are often unpopular with incumbent homeowners. And we know historically in some parts of California that we've had incomplete adoption of recommended wildfire building codes in some places where local governments make those decisions. This is a much more complicated issue than I'm doing justice to on this one slide. But this slide and the slide before it have given you sort of a menu of reasons that you might expect there to be a role for building codes in encouraging wildfire adaptation in residential areas. Okay, so that's the institutional overview. This slide is giving you a whole bunch of information on how WUI building codes vary across California. And this is the place where in the long version of the talk, I go through this in a lot of detail. For the short version of the talk, I'm just going to summarize this by saying there's spatial variation. So there are different codes in different places. And there's also temporal or historical variation in the sense that there have been changes over time in the codes that apply in a given jurisdiction. And all of that variation in building codes is going to help us identify the effect of those WUI building codes on structural resilience. There are two particular regimes that I'm going to refer back to at various points in the talk. So those are what I really need you to take away from this slide. The first is this idea of what's called the state responsibility area, or SRA. So in SRA areas, compliance with WUI building codes has been mandatory for a number of years. And the second code regime that I'm going to be referring back to a few times is a very particular type of area inside of what's called local responsibility area. So there's a subset of local responsibility areas where CAL FIRE has designated what are called very high fire hazard severity zones. I know that terminology is a little overwhelming if you don't live and breathe in this space every day, but just think about this latter group of homes as an area where local governments have the final say. CAL FIRE has historically recommended that these are places that adopt more stringent WUI building codes, and local governments have then decided whether or not to opt in and adopt those codes. In more recent years, that ability to opt in or opt out has been shrinking, but you don't need to worry so much about that for the talk because we're going to be thinking about things that happened a few years ago. Okay, so that's the short overview of variation in building codes. Let me talk to you also very quickly about changes over time in WUI building codes in California. And I want to talk particularly about two kind of historical eras. The first point in time that I want to think about is really important is the years immediately following the 1991 Oakland firestorm. So the 1991 Oakland firestorm at the time was a completely appalling fire disaster, one of the worst that the United States had ever seen. And it catalyzed a bunch of building code reforms in Sacramento in the several years that followed, including the important Bates Bill of 1992, and then a series of other measures related to wildfire mitigation that followed on that in subsequent years. And then the second sort of period that I want to think about as a period of change is around 2007, 2008, when we get implementation of what are called the Chapter 7A building codes. Those are the modern WUI building codes that pretty much still govern WUI construction in California today. And again, think about these standards as having been mandatory in state responsibility area and recommended to be adopted by local governments in local responsibility area. Okay. Okay, we've waded through the thicket of institutional details, and now I can tell you a little bit about the data that we've actually put together. So what we've done is that we've compiled post-fire damage censuses for 112 wildfires from 2003 to 2020 throughout the Western United States. Most of them are in California, simply because most damaging wildfires have happened in California. But we also have fires in other states that I'll tell you about. For all of these homes, we know an assessor parcel number, the street address of the home, the extent of the damage caused by the fire. And in terms of data sources, for more recent California fires, we can get this from the CAL FIRE Damage Inspection Database, the DINS dataset, for those who know this area. For the earlier California fires and for fires in other states, we've put in a ton of work to augment this data set by going county to county and talking to individual county assessors to try and get their post-fire damage inspection data or their tax assessment data. And we've worked with a bunch of other sources as well to try and put together this as comprehensive a database as we can of destroyed homes. On the bottom of the slide here, you just have a figure that's showing you the sort of temporal coverage of the fires in our data set, and then the colors are telling you whether they're telling you the source of the data. Okay, we take that list of destroyed homes, we merge it to the universe of real estate assessor data for all residential properties in the United States. This is useful for a couple reasons, but the most important reason that this is useful for us is that it gives us all of the homes that were exposed to the fire but not destroyed, and so don't show up in the destroyed properties data. We're going to limit the data set then to single family homes because that's our primary population of interest in this paper, and that's the data set that we're going to be working with as we go forward. Let me give you sort of a quick summary of the merged data. The final data set includes about 52,000 homes that experienced wildfires in California, Oregon, Washington, and Arizona. 41% of those homes were destroyed. And then this figure is giving you a graphical overview of the data. So down here on the horizontal axis, we have the year that the home was built. These gray bars are showing you the distribution of year built for homes in our sample. And then the red dots are showing you the share of homes for every year built that were destroyed by the fires in our sample. And so just to do a quick check on understanding, let me remind you that all of the fires that we're working with in this paper happened in 2003 or later. So this x-axis is not the year of the fire. What this is telling you is that the homes that we are studying in this paper were built across a wide range of years. Or said differently, the recent fires that we study in this paper hit a population of homes of very different ages. And you can see there's somewhat of a downward trend just in the raw data, which suggests increasing survivability for newer homes just from eyeballing the raw data. Okay. So this is another place where I'm going to go fast. I'll just tell you that we've put a lot of time and effort into carefully validating many features of the data set, including the location of the home. So we've worked very hard to make sure that we are precisely identifying the actual rooftop locations of the homes in our data set. This is aerial imagery of the area of the car fire in Redding, California. Dots are showing you where we think homes are, and then we're just validating that against aerial imagery and seeing that, that is in fact where homes are. We've also worked hard to validate the damage report data. So aerial imagery is really helpful here. Again, this is the same place after the car fire. So this is post-fire imagery. Yellow dots are homes that show up as destroyed in our data set. And you can see there's this sort of immediate usefulness of the aerial imagery for validation, yellow homes do, in fact, obviously were destroyed by the fire, and the purple homes that we have marked down as surviving the fire did, in fact, survive the fire. Right? So we've done a lot of this kind of quality checking and validation. We can then make figures that look like this one. So we have a map like this for all of the 112 fires in our data set. This is the Woolsey fire in 2018 near Los Angeles. So I'm sure many people attending this meeting remember the Woolsey fire. The black street map data here is just giving you a sense of development density. The red line is the wildfire perimeter. And then the green and purple dots are showing each X is a home inside of the Woolsey fire perimeter. The purple dots are homes that were destroyed by the fire, and the green dots are homes that survived the fire. Okay, so we can do this for all the homes in our data set. With all of that set up, so now I've talked to you about the sort of economics of the problem. I've talked to you about the institutional details. I've talked to you about how we put together the data. I've got a few minutes left to tell you what it is that we think we're learning. So let me first start out just by cutting the data to consider only homes in state responsibility area. So only homes in parts of California where the mid-1990s building code changes were mandatory. And I'm going to show you the likelihood of destruction for homes built in various years using this chart right here. So this is showing you, for example, that 1990 homes during the fires in our sample had about a 35% destruction probability compared to, for example, 2000 or 2001 homes, which were only about 20-21% likely to be destroyed. So there's this, clear trend in increasing survivability throughout the mid-1990s as we get this implementation of the post-tunnel fire building codes. I'm going to skip a couple of slides, and I'm going to start talking to you about more complicated statistical techniques. And so this is a slide that's really oriented towards more of a technical audience. So I'll just tell you the high-level version of what we do here is that we use a statistical technique that compares homes on the same residential street that were built before or after the adoption of WUI building codes in that given area. So this comparison is really useful because it allows us to compare two homes that differ in the codes that were in place when the home was built, but otherwise experience extremely similar wildfire exposures because they are located very, very close to each other. And I think that I'm getting short on time, so I'm just going to very quickly tell you the regression estimates do a very nice job of kind of purging a lot of noise and potential bias out of the data. And what we can see, again, in the mandatory code compliance areas is that there's these immediate improvements in survivability following the tunnel fire in the mid-1990s code changes, survivability for homes built after 2008, and the Chapter 7A requirements is even better. This is all in state responsibility area. The story is mostly similar in local responsibility area, very high fire hazard severity zones. There are some interesting differences in the timing of improvements here that we talk about in the paper that I don't have time to tell you about here. Two things that I do want to make sure I have time to show you. One, we do this same analysis for homes outside of California and homes in parts of California that have not had building codes, WUI building codes, and we don't see the same magnitude of vintage effects, right? We don't see the same kind of improvements in survivability following the mid-1990s for homes in Oregon or homes in Arizona, homes in Washington. And to us, that really strongly suggests that the improvements that we're seeing for mid-1990s and newer homes in California really are due to building codes as opposed to other factors. I'm going to skip some regression tables. And then the last thing that I want to tell you before I wrap it up is that we also find what I consider to be pretty convincing evidence that being located next within about 30 meters of a pre-code compliant neighbor increases one's own risk of destruction during a wildfire. And so the estimates here are suggesting that having one pre-code neighbor within about 20 meters increases my own probability of destruction by about 2 percentage points if exposed to a wildfire. And so I'll put my conclusions up on the slide here, and I'll leave it there because I know I'm over time. Hi all. I think I'll try and answer some questions while Laura works on her audio. So let me take a look at the Q&A. Yeah. So Penny has Yanjun has a question about renovations, which definitely is an interesting thing that we talk about in the paper. So we do see that homes that are old enough that they're likely to have been re-roofed following the changes in roofing codes do have sort of the pattern that you would expect of improved survivability. Let's see. Arlene has a question about the main protective elements of the newer code. So this is really something that we're excited to try and dig more into. So the codes are sort of a bundle of things, right? And so teasing apart what is it exactly about that bundle that's delivering the biggest bang for the buck is a really important area of research that we want to see what we can contribute to. But sort of a few things that seem to be really important in these codes: roofing, so having a class A, class B roof, screening of vents, eaves. There is also a set of rules around defensible space that are not necessarily related to the construction of the structure, but there's a whole bundle of things that happen here, and trying to tease apart what the kind of bang for the buck for each of them is a really important question. Yeah, I'm just going to keep answering questions until someone tells me to stop, because I think this is really interesting. There's a question about linking to about essentially whether these increases in survivability are capitalized into the value of the home. So when people turn around and sell their home, do they get a higher value for it? That's something that we have the ability to look at because we have the transaction data. My hypothesis is that we're not going to see much of a capitalization effect, just because all of the previous evidence suggests that people don't understand this risk very well, which to me would suggest that the market's not going to be willing to pay for it. Okay, so I think I'll stop there and see if we have our audio back. So I know there are a couple questions I didn't get to, I think, from Sarah and Philip. Guys, you guys and everyone else, I would love to follow up offline, talk more about the paper and the questions. But thank you for attending, everyone.
Hi, can oh okay yeah how about now? Okay good. Well okay good. I will move on. Okay. Good afternoon everybody. My name is Wangyang Lai. I'm from Shanghai University of Finance and Economics. Uh, uh, okay. So I'm very happy to present our work here today. So this paper is co-authored with Sanjun Li and Pander Barwick from Cornell University and Yanyan Liu from IFRI. Adaptation mitigates the negative temperature shock on household consumption. I will be quick on the introduction. So from many of the IPCC reports, we know that climate change is happening. Climate change is increasing the frequency and the intensity of extreme weather. Existing literature has documented the impact of temperature on economic growth, as well as many channels how that happens. For example, how temperature affects agricultural production, how temperature affects the formation of human capital or labor supply. However, the previous studies mainly focus on the production size, and not many estimate the direct impact of temperature on consumption. This is the motivation of our study because we know that consumption plays a key role in economic growth. So we have three objectives in this paper. The first one is to quantify the direct impact of temperature on consumption. And the second one is to identify the pattern of adaptation. And the third one is to predict future impacts. Let me skip the literature. Let's see the data we use for the analysis. So the consumption data is from the transaction of debit and credit cards in China from the UnionPay network from 2013 to 2018. UnionPay is the only net interbank network, and also it's the largest network in China, and to the best of our knowledge, this data is the most comprehensive consumption data in China. And the data are aggregated at a city by date level for our analysis. And weather data is from the European Center for Medium Range Weather Forecast. And we link the consumption data with the weather data by the central year of the city with the grid from the with the nearest grid from the weather data. And later we need to do some future prediction, and we need to use the projected temperature and projected GDP, and these projection data are from NASA projection and shared socio-economic pathways. This is the data, and here is just a sample distribution of our bank card. Then this is the baseline model. Y here is the value of transaction per card in CTC at date T, and TP here is the TP here is the dummy variables for each five Fahrenheit degree. And the dummy variables here are set to capture the nonlinear impact. And the temperature we use to create these TP dummies are the average temperature from the last 10 days. So we specify a window of 10 days in order to capture some lagged effects of temperature or some intertemporal substitution. For example, for the health spending, after exposure to extreme weather, there might be some periods of incubation for the illness to show symptoms. And also consumers may reschedule their shopping or entertainment activities to other later days if the weather is bad today. And we also try windows larger or shorter than 10 days. And the results shows that for most activities, the window the lag effect are likely to be within 10 days. So this is the key variables here, the TP dummies. And X here is the control variables. So it includes the air pollution and other weather controls such as precipitation and humidity. And in the model we also include date fixed effects as well as city by quarter fixed effects. So the model are also robust to using city by month fixed effects or city specific time trend. The model are also robust to delete or add these control variables. And the given the temperature itself is exogenous, and we have many fixed effects. So the beta here can be interpreted as a causal impact of temperature on consumption. And for these dummies, the temperature being that maximize or minimize the response function will be the reference being. So here is the result, the temperature impact on consumption, and we find a very robust inverse U shape. So both hot days and cold days reduce consumption. And on very cold days, the reduction is about 3%, and on very hot days, the reduction is about 6%. So from this finding, the inverse U-shape finding, actually we cannot tell as climate becomes warmer in the future, whether whether the consumption reduction in the future will be more or less than now. So I mean, on you can see on the right side, on very hot days, we see consumption reduction. So as climate become warmer, we'll have more hot days, then there will be more consumption reduction. But on very cold days, as climate becomes warmer, there will be less cold days. So consumption reduction will decrease. So for the net change, it's not clear as climate becomes warmer whether the future consumption reduction will be more or less than now. Yeah, that's one thing I want to highlight. And the second things I want to say is that recall that one of the objectives of this paper is to predict future impacts. So if we use the relationship now between temperature and consumption to predict future impacts, one concern is that people might adapt. That means the marginal impact here may change over time. So it's not appropriate to use the relationship now to predict future relation. So next I continue to explore some adaptation patterns. So I now separately estimate the impact of temperature on consumption by climate zones. So climate in this paper is defined as average temperature for the last 30 years. Average temperature for the last 30 years. And hot region means the areas with average temperature at the top 30%. And the mild means the regions with the average temperature at the middle 30%. And the cold areas are the bottom 40%. And then so what do we find here? And so this is so the red line here is for the marginal impact of temperature on consumption for the cold area, and the blue line is for the mild area, and the hot line, a green line is for the hot area. And let's read the right side first. The right side, on very hot days, the cold areas have the largest consumption reduction, but the hot areas have the least consumption reduction. For the very cold days, hot areas have much larger consumption reduction than cold areas. And so that means the marginal impact of temperature on consumption changes in different climate regions. Hot regions are less affected by hot days. Hot regions are less affected by hot days, and the cold regions are less affected by cold days. So this is the evidence of adaptation. So then the next question is how does that adaptation happens? So the adaptation happens. It can happen through many ways. In maybe the change of the building environment, such as the air conditioner, or maybe the regulations on the landscape or urban planning, or maybe even the biological adaptation. So it can be too many ways. So beyond the discussion of this paper. Okay, and next thing I want to mention is that from this finding, again, it's not clear whether the future consumption reduction will be more or less than now. So I mean, in a cold, in a hot region, as climate becomes warmer, we can adapt to hot days. So as climate becomes warmer, the consumption reduction will reduce. However, when we are adapting to hot climate, we are actually are not used to cold days anymore. So that means as climate becomes warmer in the future, for the same cold days, the consumption reduction will be more. So adapting to hot days, so we have less consumption reduction, but not used to cold days anymore. So we have more consumption reduction. So for the net change, it's still it's not clear whether the future consumption reduction will be more or less than now. So just a very quick summary. So for the temperature impacts we found previously, and for the adaptation impacts we find in this figure, both we cannot tell. It's not clear whether the future consumption reduction will be more or less than now. So next, I continue to predict the future consumption change, incorporating the temperature impacts and the adaptation impacts we find here.
Wangyang, I just wanted to let you know you have about 2 minutes left.
We have two minutes left. Okay. So the model for the future prediction. So the idea is similar with the model 1. It's just we make it more parametric. So the first line here is a linear spline function. It captures the temperature impact, and for the second line and the third line, we allow the temperature impact to change over climate and change over GDP. So climate capture the adaptation impacts, and the GDP reflects the budget constraint. And here's the intuition behind this model, or the assumption behind this model for adaptation. So the intuition is that, so if Beijing's climate in the future becomes Shanghai's climate now, then Beijing's consumption temperature relationship in the future will be like Shanghai's consumption temperature relationship now. So so this model captured the adaptation to the extent that other regions already adapt to their current climate. There's also an assumption. And then after we estimate the model 2, we get all the parameters, and we just need to put in the temperature projection from NASA in this model 2. Then we can predict future temperature impacts for each value of temperature under each value of climate. And then we do two cases of simulations. One is no adaptation, one is adaptation. So I want to mention that so when we talk about temperature or adaptation impacts, we are comparing with the reference group. But when we are talking about prediction, we are comparing future with now. the change between future and now. So for the first scenario, it's no adaptation. We mean we allow the temperature to change over time, but we keep the climate as now. But for the adaptation scenario, we allow both temperature and the climate to change over time, and this is two scenarios. Now let's see the this is just a result from estimating equation 2, and this is the figure for the prediction results. So y-axis here is the percentage change of consumption reduction in the future relative to now. So we see that in the case of no adaptation, under both RCP 4.5 scenario and the RCP 8.5 scenario, the future consumption reduction will be more than now, and the RCP 8.5 have larger consumption reduction. But if we consider adaptation, then the future consumption reduction will be similar with now. So the difference are close to zero and not significant. And if we see more heterogeneities across regions, and overall we can see that in the case of no adaptation, the southern China will have more consumption reduction. However, if we consider the case of adaptation, the northern China will have more consumption reduction because the southern China they are already used to hot days, and this is the result for the future prediction. Then just a quick summary. So 3 objectives in this paper and three findings. For the temperature impact, we found both hot days and cold days have negative impact on consumption. For the adaptation impacts, hot regions are less affected by hot days, but cold regions are less affected by cold days. And for the future prediction, without adaptation, future consumption reduction will be more than now. But if we consider adaptation, future consumption reduction will similar with now, and there are no significant difference. Yeah, I think that's all I want to present today. Yeah, thank you.
Great. Thank you so much, Wangyang. Now I need to check again.
Back.
Is my audio coming through? Okay, good.
Yeah.
The audio seems very touchy in this portal. So thank you so much, Wangyang. That was very interesting. I have a question. I'm wondering if you can just explain in kind of ordinary terms why it is you think people are spending less money during periods of extreme temperatures.
Okay, so say today weather is really bad, and I was supposed to go shopping with my friends, but it's just the weather is bad, so I just stay home. So let's one example. The extreme temperature reduce the consumption, or maybe even if the weather is too bad and it's too hot or too cold and I get sick, then I can not go to consumption to do shopping as well. Yeah.
Okay.
So that's an example.
Does transportation get disrupted as well? People the shipping routes get disrupted during extreme temperature? Or do you think it's mostly just people changing their behavior and staying home?
So for the overall transportation, so for the transportation have many purposes. So for this like going to work, so these are less affected. But for those more that has more, it's not compulsory, that will be affected.
I see.
Yeah.
And then we have a question in the chat asking you, do you know what types of consumption are most affected?
Well, yeah, we in the paper we do have a very subcategory analysis. So I would say for the cold days, many of the activity are affected, and let me see which one is well, the things I recall now is the for the cash spending. So for the cash spending on very cold days, I think it decreased a lot. Yeah. And for the food subcategory, I think it's less affected because I think the food is something that's necessary. And we do have some subcategory analysis. Yeah.
Okay. So look to the paper to read more. Well, thank you so much. And now I think everybody, all of our speakers will join us again, and we have some time to take questions from the audience for all three of the speakers. And then if we have some time, some chance for the speakers to talk among themselves and ask each other some questions as well. So I think one question that I think a few people have asked for various versions of is for Judd, which is, you've made a great case that building codes have a huge impact on the survivorship of homes from wildfires. Do you have recommendations on policy changes that would increase the reach of these more protected building codes in California and or the US?
So I've turned my camera on again. I'm really rolling the dice here. Gonna hope this works. So, that's definitely the right question. The first thing that comes to mind is that California is not the only state in the United States, right? So California's recent codes are pretty good, but there are a whole bunch of other states, for example, Oregon, which had devastating fires last summer, that don't have the same kind of building code. So I think one thing that seems like it would be pretty cost effective from our paper is, other states could try and catch up to California in terms of building codes, and that's going to become more important as wildfire risk gets worse and worse. And then the other area that we're really trying to do more to untangle in the work right now is, can we get a little more surgical and try and say something about which investments deliver a really big bang for the buck for this population of existing homes that were built, many years ago, that are going to be really hard to deal with because retrofitting them is likely to be more expensive than dealing with this when you build the home new. And that's where and a lot of other people have thought about this question as well. And it's important to say that there's a very nice existing literature about various things that people can do with their homes and how they affect survivability. But we want to try and extend that and see if we can really identify some cost-effective investments for older homes.
Great. Yeah, I'm sure that will be hugely interesting, because that's the question that always comes up, is which ones of these interventions are actually cost effective. So one of the other questions that we have in the chat is again for Judd, and asking whether you can go over, well, it sounds like perhaps this is what you plan to analyze, but asking if you can call out what the main protective elements of the newer codes are.
Oh yeah, so I had a quick chance to answer that, I think, while your audio was out, Laura. And I had mentioned that it's a bundle of things involving roofs and venting of mesh across vents and eave mitigation and a whole bunch of other things. And so thinking about what it is in this bundle of investments that's really important is something that we want to try and figure out.
I was probably too busy trying to troubleshoot to pay attention to the Q&A at that moment. So we have just a couple of minutes left, and we have some time for the panelists to ask each other some of the questions that they've been wondering about during this time. Would any of you like to go first?
Yeah, I actually also have a question for Judd. I'm wondering if in your results you find some neighboring effects. And I don't know if this is related, but I'm kind of wondering whether there is a way to identify if there is a density effect as well. Like if you have like denser built environments, does that also reduce um, fire damage?
Yeah, so we find that the neighbor spillovers are most pronounced in places where homes are located really close together, which is sort of consistent with what you would expect when your flammable neighbors are located inside of what's called the home ignition zone. That's where you're most likely to have this kind of structure-to-structure spread, and that's where we see the biggest benefits. We see that those benefits kind of attenuate when we start to think about areas where homes are spaced more widely.
That's so interesting. It's like, so it's like if we want to target some place, to do more retrofitting, then those will be the areas that.
Yeah, so we have this kind of policy experiment in the back of our heads that we're going to try and here's the thought experiment that we're going to try and flesh out as much as we can. Sort of take a given area, think about what the density is in terms of the number of neighbors. Think about some measure, some cost of building the house to code, and just think about how likely do you have to think a wildfire is in a given place for these investments to be cost effective. Right? That's kind of the calculation that we would love to be able to deliver in the conclusion of the paper, and we're working on it basically.
Thanks. Great question.
Yeah, hi, Jad. And just a more general question. So how do you come up with this research idea?
Well, Patrick and I have been thinking about fires for a few years now, and this is one that we've been wanting to work on.
Okay. Yeah, I worked with fire for some papers as well. Yeah.
Well, we're reaching the end of our time. Thanks everybody for the great discussion and the great questions. I think it's really interesting to think about how a global issue like climate change is moderated by all these factors like policy and building codes and insurance and just people's behavioral reactions to extreme weather, and has then these very personal impacts on people's homes and damage from an economic fallout from climate change. So thank you for joining us. And I also want to mention that we have, of course, interesting sessions coming up tomorrow. We have the cumulative costs of climate change, how heat vulnerability affects workers, healthcare, and neighborhoods, innovative toolkits for urban heat adaptation, housing and hazards, how should we protect vulnerable homes, emerging research on financial adaptations to climate impacts, and wading into the economic impacts of climate change on water. And then finally, the equitable adaptation to climate-related flood risks, which apparently is part 2 of a 2-part series. So hope to see you all there, and thank you so much again to Yanjun and to Judd and to Wangyang for joining us, and have a great evening, you guys.
Thank you. Thank you. Have a great day. Yeah, bye. Okay, how just